Right, so if you never watched my first two videos before this, I did up to seven. I'm chapter one and chapter two. Now we're still on chapter two, but now we're doing calculations. Extremely important. Right, so what's going on over here, right? So I'm just checking out where's the question here. Okay, there's not giving me a question here. Okay, so I'm just gonna explain it very easy, right? Okay, so your sales. Now, if you given the sales amount, let's say 18,200, all you have to do in creating to work at your operating profit is put sales and the amount, right? Now, this amount right now, you'll just leave it over here because I want you to see gross profit 7,000. The way you work out gross profit is sales minus cost of sales. Sales minus cost of sales. But everything over here is working out cost of sales, you see? So he's saying this minus this is equals to gross profit. But cost of sales needs to be a calculation first before you like obviously say sales minus cost of sales, because all this needs to be calculated to become cost of sales. So that is why we're doing this, right? So this is actually the cost of sales figure 11,200. This is done by working with this only, not with this number. So that's something you must take note. But very simple. Direct labor. Okay, so I can't see the question. Oh, they say 70% of the product cost. Are therefore identified as an expense. Okay. So, I'm just seeing how they're given this to you. Okay. So if they give 16,000, right? If they give 16,000, and they said like a certain percentage of the 16,000 is direct material, direct labor, manufacturing overheads, you allocate it, right? In this case, I'm thinking how they allocated 8, 9, 10, 11, 12, 13, 14, 15, 16. Okay, it's very easy. If they give you in the question 16,000 rand, and they say 50% of the 16,000 rand is allocated to direct materials, as you can see, you work out 50% of that amount, you get 8,000. So you put it there. They'll say 25% is linked with direct labor, you work that out, you got 4,000. Do that for the other one also, you'll get 4,000. Right? All this added together is going to give you 16,000. Then the formula goes, you minus the closing inventory and the minus the finished goods closing inventory. So when you take this, minus this, you'll get this figure 11,200. The way they got 4,800, they added this. So the way, I don't know why they do this like so complicated, but you take this, you add it. No, sorry, 1 second. You minus it. Why you minus it? Because it says less. So less closing inventory and less finished stocks inventory. So that means you minus. So you take this amount. So they added these two together to get this 4,800. And then this minus this will give you this. Or you can just say this minus this will give you that same amount, right? Then, there we go. Then now we say sales minus your cost of sales. This was the cost of sales. You get 7,000. Now you say your period cost, also known as non-manufacturing cost, which is your selling selling cost or your administration cost. That will be 6,000. This minus this will give you your net profit, operating profit, 1,000. Right, so that's how it works. So it's basically this amount plus this amount plus this amount plus this amount minus this amount minus this amount. You got that minus that minus that. Right? So yeah. And this is the same thing. Okay, so product cost I told you, in it got direct cost and indirect cost, right? Non-production cost, also known as your period cost, are your two things. I told you always two things: selling and distribution, or your administration cost. All that put together will total cost of operations. Now, very thing important here is to make note of this prime cost. Prime cost is all your direct cost. So prime cost is equal to your direct material plus direct labor and any any direct expense. So any direct expense. So basically all direct cost is prime cost. Yeah, basically. Indirect production cost is your factory overheads that are indirect, right? The indirect labors. Okay, so basically easy, right? These are all indirect cost. These are all direct cost. You see, prime cost all direct cost, overheads are all indirect cost. Easy. And that makes sense, completely makes sense. Okay, so this is easy. A company may have 6,000 chairs and 4,000 chairs during the year. Direct material cost for the year. I'm just thinking direct material cost for the year. So always when you're working with these numbers, you'll work with this amount, 6,000 chairs, because you made 6,000 chairs for the year. So according to the accrual concept, in accounting, if you did something and it had an expense for that period, you have to record it. So it's very simple. You say 6,000 rand times 5, right? That'll give you the answer. Direct labor, it's same. You do that, right? But this says 2 rand hours and 3 rand per hour. 6 rand. It'll be 6,000 times 6, because they say per unit. Per unit, 6 rand. Yeah, 6 times 6,000 will give you the answer. Then your prime cost will be obviously you add number ones and two answer. So all the direct cost. Conversion cost, okay. Over here now they're going to conversion cost. We never learned it as yet, right? So let's learn it now. Right. So all this now are known as your direct cost, right? All this known is your indirect cost. This will give you a total production cost. But now your non-manufacturing cost or your non-production is two things, your marketing or your admin, right? Both all together will give you cost of operations. Now what is conversion cost? Very easy. It's all your manufacturing cost or your production cost, which is same thing. Manufacturing cost, production cost, same thing. Minus your direct material. So they basically have all your production costs and they leave out direct material. So or you can just do this. You can add all your direct cost. Oh no, sorry. You can add all your production cost but leave out direct material. That's basically what it is. So they're adding this here, adding this here, adding this, adding this, adding this. Right? But don't add your direct material. Add all your production costs but not direct material. So prime cost per year will be +1 +2 is answer, right? Easy. Total cost of operations will be all the cost of above, right? Direct material, direct labor. You wouldn't repeat conversion cost. You'll say direct material, direct labor, then you'll say plus non-manufacturing cost for the year. That'll give you a total cost of operations. Yeah. Yeah. And don't forget, right, at the end of the day, you start to work at indirect labor per unit. That goes under overheads and stuff, right? So even though they don't give you a question to work out like factory overheads, you must do it. Factory overheads is simple, right? Direct labor, for example, they're saying per unit is 1 rand. If you made 6,000 chairs, it'll be 6,000 times 1, that's 6,000 for direct labor. So it's not that bad. Okay, so these are a lot of calculations, but I explained enough so you can do it. Now, determining relevant information. There's relevant costs and non-relevant costs. Relevant costs are costs that are important to you and you need to take into consideration. Non-relevant, you don't care about the cost. It doesn't affect you. So relevant costs are costs that is like you must take note of, right? Important. They're future, meaning the avoidable cost. So if you have something in the future that will cost you something and you can avoid it, it means that they are relevant costs, right? They either can cost you it and not cost you it. Incremental is the differentiation cost. So that's when you have two options. You're either going to manufacture product A that costs 2,000 or B that costs 10,000. The difference is the differential cost. Cash flows, opportunity cost is basically, opportunity cost is very relevant because it's an opportunity cost, it's a cost that you're leaving out, right? If a machine gives you a profit of 10,000 rand, but you need to buy a new machine for 100,000 rand, but buying the new machine for 100,000 rand, the machine that you have in your business won't work. What is the opportunity cost? It'll be the cost of the new machine, 100,000 rand, and it'll be the amount of products the other machine in your business was making, or the profit it was making. In this case, 10,000, I said. So your total production cost, or total opportunity cost, will be 110,000. So relevant cost of materials, obviously, when a product is not in stock, you must buy it. When it's continually in use, people are buying it, you must replace it on the shelves. No other use, you mustn't be replaced because no one wants it anymore. Scarce. If take from inventory, you can't replace. So whatever you take from the inventory shelf, know that you cannot order it back. Okay, so non-avoidable fixed cost. Now these are non-relevant costs. You don't care about it. If you're going to pay rent every month for 2,000, you can't change it no matter what, so forget about this. Some costs are costs that you incur already. If you buy airtime for 100 rand, you already spent 100 rand. So technically, it doesn't matter why you should be considering the 100 rand in airtime you got. No, you already done the payment. So you already make payment, done, finished, buy. You don't care about it. Committed is contract, so you promise someone to give you money or make money. Notational is your accounting entries for non-cash items. So your depreciation is non-relevant cost, right? The actual cost. Okay, so this is an opportunity cost question, but the best one to use will be this. It's harder and it covers everything. Okay, so very easy. Pause this and read this, but basically, okay, so read it first, right? So basically, you have this one machine in the business, but you want to replace it with another machine. But when you replace it with another machine, this old machine that is previously in your business will lose 4,000 worth of products because you have to stop operations to launch the machine. So the opportunity cost I told you is the new product cost of the machine, which is 20,000 for the new machine, plus any loss of the profits, right? That you're going to incur a loss of 4,000 with the old machine because you're not going to manufacture those products. So 24,000 is your opportunity cost. So will you accept an order of 22,000? No. Because if the opportunity cost is 24,000, it's technically saying you're making 24,000. If this is less than that, then it's a loss. So no. Would you accept 22,000? If you're not working at full capacity. If they say you're not working at full capacity, see this 4,000 loss they're saying you made, you pretend that this doesn't exist. Not working at full capacity means you're not going to make a loss in the machine. So you erase this. So the only cost you have is 20,000, right? Not the 4,000. So if 20,000 rand is the cost, and if you're getting 22,000 rand, plus 2,000 rand is your profit, therefore you take it. And that's it for this video.